I'm Grant Walker. Welcome to Last Call for Monday the 20th of July. I'll be back with Heads Up Tuesday, 10 a.m. In market news, Somerset Group, New Zealand's third largest listed retirement village operator, has bought land in Warkworth, enabling it to extend its existing village. The company bought an extra 2.4 hectares, which would allow it to build 77 retirement units next to its Somerset Falls village. It said the current village has 220 residents and is almost complete, with a care apartment building due for completion next year. Chief Executive Julian Cook said, "We've experienced very strong interest in the Warkworth area. With the purchase of this land, we will be able to extend our village and provide more retirement village living options to the wider Warkworth community." Somerset has said 2015 underlying earnings will probably rise as much as 39% as it benefits from record sales of units. It said today it's on target to deliver 300 retirement units across its 20 villages in 2015 and to exceed 300 units in 2016. It continues to look for additional sites across the country. The earnings forecast doesn't include the impact of unrealised property valuation gains. It will publish first half earnings on August 11. Shares in Somerset last traded at $3.92. The stock has gained 42% so far this year, making it the second best performer on the S&P NZX 50 index behind Newplex Industries, which has gained 45%. To our dollar, and the New Zealand dollar found support around 65 US cents, which Prime Minister John Key has previously referred to as the Goldilocks level, neither too high nor too low, following a sharp decline as traders priced in more interest rate cuts following weak dairy prices. The Kiwi was trading at 65.15 US cents at 8 this morning, from 65.11 at the New York close and 65.41 cents at 5 on Friday. The TWI edged lower to 69.31. The local currency dropped more than 2% last week after a slump in milk powder prices at the GDT auction fueled calls for the Reserve Bank to cut interest rates more aggressively to prop up the country's biggest export sector. The Kiwi's decline appears to have halted for now as traders assess their positions ahead of the Reserve Bank interest rate decision on Thursday. All economists in a Reuters poll expect a 25 basis point cut this week, although some say there is an outside chance the bank could reduce the rate by as much as 50 basis points. Bank of New Zealand currency strategist Raiko Sharif said in a note, "For the time being, the 0.65 level looks to provide some support, with the bottom of the trend channel at 0.648. New Zealand dollar does seem due for a period of consolidation, but we would not bank on a material rally, with the fundamental outlook over the near term rather grim." In New Zealand today, the BNZ Business New Zealand Performance of Services Index is scheduled for release. So this morning at 8, the New Zealand dollar advanced to 88.3 Australian. It went to 60.11 euro cents from 60.03 and edged lower to 41.73 British pence and slipped to 80.79 yen.
NBR Radio, Monday the 20th of July. I'm Andrew Patterson, and with me Nathan Smith. Nathan, your piece today, as China buys houses, New Zealand should heed warnings of history. You've taken a look at a range of perspectives on this issue, and you argue that if the central issue of high Auckland house prices is the result of Chinese citizens buying New Zealand houses, then the question needs to be asked, why are the Chinese buying Kiwi houses? What did you conclude?
Well, I mean, I go back and I run the parallel of what happened with Japan over the 1980s, and eventually, as we all know the story, it collapsed in the early 90s. And they're still trying to work themselves out of that now with Abenomics and those sorts of things. But look, Japan's in a nice, tough place. And it didn't get there magically. It got there because of, ironically enough, land value prices in that country, and what the Chinese and what the Japanese businessmen wished to do with the money at that time. Back then in the 1980s, there was a huge rise, first starting with a trickle, turning into a torrent of investing in the west coast of America. And Hawaii, Pebble Beach is a great example of that. And the question was never asked, or seemingly never asked back then, hold on, why are the Japanese not reinvesting in their own economy? Turns out only a couple of years later that when the government decided to change some of those land value laws or how you buy houses, that particular real estate market crashed, and there are other places that led on from that, and they fell into what was known as the lost decades, as I said before, which we're just trying to emerge from now, 20 years later. That, I think, should be a canary down the gold shaft, so to speak, for what's going on with China. What do the Chinese businessmen know about their own economy that they refuse to reinvest in, and they decide to not fly with their capital, but reinvest elsewhere in the world?
And there seems to be a view by many of them that they don't really care about the property. It's just the fact that you can actually buy something and get the money here.
Yeah, that's right. One of the big differences between a foreign investor and a New Zealand investor is that after 5 years of owning a house, a domestic investor will probably sell for a profit, whereas an Indian or Chinese or Japanese person buying a house in New Zealand will sit on it for 20 or 30 years. The idea is a store of capital, somewhere safer than your economy, and this, I think, should tell us something.
What then do you think are some of the ways that New Zealand should be thinking about this? Because I suppose the other issue that, as you've raised, we don't tend to be concerned about the Shania Twains and the James Camerons. I suppose that's around the relationship that we have with the US versus the relationship with China, which is a new relationship for New Zealand. How do we differentiate between those two?
Well, it's something I think we should be looking for a long-term aspect here. This is not an accident, for instance, that we are dealing with China in the way we are now. However, the current dynamics around the Asia Pacific suggest we should put one foot in both camps. And look, I think that's a very smart thing to do, and there are often free trade deals growing at the moment, which will make that a lot easier. And our trade team is, I think, one of the best we've had in decades. So they're opening up platforms and access to markets that we simply haven't had before. But it'll be a question of whether or not the business community in New Zealand can see the writing, if there is any, on the wall of not putting eggs all in one basket in the East Asia region, and deciding maybe we can be safe here and just look elsewhere, because something is coming with China. It will just be a matter of how far the fragmentation goes when it does explode.
Yeah, this is the scale of what will be the correction that will come eventually, and its ability to manage it. And we've seen, signs of that just in recent weeks, obviously, with the government's attempt to try and manipulate the stock market. Also, what strikes me is the Americans clearly have spent a lot of time building, frameworks around soft power and so forth. And the Chinese don't seem to have done that to the same extent in countries like New Zealand. Is that because they don't want to, or they don't know how to?
I think it's a timescale thing. What we see as being the default for how to invest, or where the main centre of gravity in the world economy is, or how to push your money around the world, or what business looks like, comes from the American structure in this. And this is not biological. This is not something you just are born with an understanding of. It takes what's been about 70-odd years since the end of World War II for us to adopt that as our default policy. But this is a long time for this sort of idea to percolate through generations. And America has the other side of this, which is the hard power, which is moving the masses of men and metal around, and that's quite intimidating for things. But the soft power goes beyond borders. It's the selling of TVs, movies, books, media around the world, the concept of aid programs or the Peace Corps, all those sorts of things. They are American structures, and they push American ideas around the world. And so when we hear the James Camerons or the Shania Twains or whoever invests from America and New Zealand, we tend not to bat an eye, because that's expected. But when the Chinese come down here to do this, it's a failure not so much of their soft power program, but just a failure of the timescale in order to let that percolate into our ideas and see the Chinese investing here as perhaps a good thing, or the way business is done in the new era or anything. That will take time, but the backlash we're seeing now against this is that realization of, hang on, you're doing something different here. I'm not used to this.
And is this potentially cyclical, though, and will pass over time, or do you think this is more sustained?
In which way?
In terms of this start of this growth of foreign investment?
Well, it's depending on what will happen with China over the next 20, 30 years. The issue is not of the Chinese people. It's not who they are that is the problem. It's really where they are. And when you have a look at the geography of China or the other East Asian regions, although they can very quickly become regional powers, they don't have the geography and the access to the things you need in order to become a large world power. That's something America will always have. Its position on two oceans, large arable landmass, very well connected between the two sides of that continent. China doesn't have those things, which means it has limits and constraints on how far it can push its power. what's cyclical about China is the fact that it rises to a level and then drops down again based on those constraints. And if you understand those constraints, you can see that cycle happening. But it's not going to get to the point where it fights or competes on a level of other countries which have a more blessed geography than it does.
What about the risk, though, that if you were to see a significant downturn in China, then that capital is repatriated out of New Zealand? Or do you think it stays here anyway?
Well, no, that's another problem as well. When it's an issue when prices go up, but prices going down is an equally bad issue. It really depends. No one can predict the height of the market. You can only do that in hindsight. The advice would be to get out as you're going up. It's very difficult to do in real estate, but when someone figures out that maybe they need to take their capital out and word gets around, markets move, and those prices will fall down. And it won't just be the Chinese that will lose out. It will be a lot of Kiwis that lose out on, because they'll expect, when they see lots of signs of dollars, they will start to rush into certain markets. When a whole bunch of people rush into those markets, you get a bubble. So it's the downward trend that will be coming that we might need to watch. That could be the cyclical part.
Or the other issue is that if as you say, the government wants that capital to be retained within China, then it begins to make it difficult for those investors to buy into places like New Zealand. And that would equally create some scary scenarios. Yeah,
well, the other dynamic to make sure that you monitor here is how the Chinese business people and how the Chinese citizens themselves feel about the security of their own government. There's a lot of things that their government simply is different from in regards to New Zealand, especially with investing in real estate. You can't buy houses. You can't buy land in China, for instance. There's a whole bunch of things that they haven't liberalised, and so they see that as being a risk in itself. So it's not just the economy; it's potentially the political aspect of China that could be moving towards some change as well.
Thank you for joining us and for the insights. Nathan Smith with us on NBR Radio.
NBR Radio. With Clooney Restaurant now offering Auckland's most exclusive private dining room. NBR Radio.
NBR Radio, Monday the 20th of July. I'm Andrew Patterson, and this is Market Talk Currency with me, Jason Walls and Sheldon Slabbert from CMC Markets. Welcome to you both. Well, Jason, last week the Kiwi dollar dropped further against most of its major trading partners, and with more cuts from the Reserve Bank forecasted, the question's got to be asked, how low will the dollar go? I'm hearing 64 at the moment.
Yeah, well, there's a lot of things being chucked around. I mean, it was this morning that Keith said that it was actually at the Goldilocks level. But just having a quick look at what happened last week, it was a huge week for the dollar. We saw that it was down 26.1% against the US, or almost 20% against the pound as well. And, of course, we dropped off against the Australian. That's obviously on the back of the global dairy trade, how it was very low, about 10.7% drop for the prices there, and as well the CPI numbers aren't looking too favourable as well. We've also got, of course, the big one this week is the Reserve Bank and their rate decision, which I use the word decision sort of loosely because practically every analyst in the country is calling a cut, aren't they, Sheldon?
That's right. For the most part, I believe the first cut or Thursday's cut is probably priced in already. It is the extent or the speed of the following cuts that I think is up to debate. We're certainly seeing at CMC, we're certainly seeing a high probability of the complete unwind of the interest rate increases we saw last year, from 2.5 in January to the 3.5 mark. That's where we topped out, and we anticipate another 75 basis points cut.
75?
From where we are now till to bring us back to about 2.5.
Yeah.
And that'll only unwind that.
What do you both believe the move will be on Thursday? Because this is the speculation, is it? Do they go in hard with 50 bips now, or do they do it in two moves?
Well, it was Westpac that were forecasting that it was forecasting 25 to 50 was actually too low, and they were getting up to 75. I saw, and I thought that's a huge unwind.
I think you raise an interesting point there, Andrew. I think the possibility of I think Thursday will probably just see the 25 basis points. However, I do I do perceive that for them to get a bit more bang for their buck, they'll probably have to do a 50 basis point cut at one point instead of these sort of gradual steps lower. I think what could perhaps see that occur is if the US Fed becomes more dovish as far as the planned interest rate hikes in September. If that gets moved on a little bit further, which again half of the economists are now looking for December, I personally don't think the Fed's going to move this year. And certainly not in Christmas. I don't think Yellen wants to be the Grinch in Christmas and move borrowing costs.
So even, there's a lot of analysts that are picking September. So you think that's just not even going to happen anymore? That's off the table?
I don't think so. I think if you take into consideration last week's weak U.S. retail sales, on top of that, the Iran nuclear deal, I think that'll probably see more oil coming to the market, and all these things are deflationary. The other thing, the Fed needs inflation. Should they hike rates, it's obviously a stronger US dollar, and that stokes further deflationary conditions. So I really don't see them raising rates this year.
When you look at your client book at CMC, where are your clients positioning at the moment?
It's quite interesting. Our book has now undergone a move to a bit more bullish on the Kiwi dollar. I think a lot of our clients are seeing this move overextended. Now, it doesn't mean that we can't maybe dip into the 64s. We see a lot of different technical and support levels around that 64 to where we are around about now. So our book is pointing for a bit of at least a relief in the Kiwi sell-off.
Because that's a real probability, isn't it? Because this move down has been so sharp, there's got to be some rebound at some point.
That's right. I mean, we've hardly seen any rebound in the Kiwi at all. It has just been pretty much one-way traffic, and
it's plummeted, especially when you look against the Australian. Especially, I mean, we were here talking a couple of months ago. It was like will we, won't we parity, but now that ship has well and truly sailed, and it's just completely peeled off, and so quickly, it's just the value has dropped.
A big rebound, and again, there, bit overshot there. The Australian economy is certainly not much stronger than ours. The outlook there is certainly not. If you look at all the commodities that they export, is in probably a worse space than ours. So I think the currency there overshot a little bit as well.
Jason, you wrote last week about how the international money markets were particularly short Kiwi dollars right now. I mean, they're potentially at risk that they get caught, obviously, on a rebound.
Yeah, well, it was the interesting thing about this is it was the future markets, and we had so many futures contracts were coming in short, and I think it was up to like the most in over 10 years or something like that, and it was negative 16. Yeah, it was insane. I mean, what was your take on that? Because obviously it was quite a big story on NBR last week, but But
the positioning is getting extreme, and that's been extreme points and slightly overextending over the last few weeks as well. So I read that article. I agree exactly with the take there. Currency markets, and especially where speculation is concerned, often overshoots, and I think this is potentially the territory we're currently in. Right,
because I mean we're down there at like negative 18,000. I mean, it's worth noting that was last week. Is this the bottom, or are we going to keep going? Is there?
Look, like I mentioned before, the possibility exists for a little bit, maybe a squeeze lower. But I certainly think this is, just if you look at it from a purely speculative point of view, risk-reward is now favouring the long side.
Right. The other part of this is, what do you think the market is focusing on specifically when it's trying to get a feel for the Kiwi? Is it ostensibly hooked, obviously, to the dairy price, but what else?
It's a yield. The yield differential is pretty much what drove us. There's this global search for yield where you've got pretty much negative interest rates in Europe, where you actually physically have to pay the bank to hold your money.
That's right, those German bonds,
which is ridiculous in itself. However, so all this money is looking for a place to actually get some yield. Now, this is something that we've been able to pay quite handsomely over the last a year or so. And while we were raising interest rates, obviously this attracted a lot of capital flow. That's reversed itself, and that risk reward now is. Especially where you see yields in the US and elsewhere increasing, that differential is shrinking, and that is certainly making us less attractive. Also, across the pond, as that differential closes between ourselves and Australia. It's attracting more capital there. Just seeing that it's a bigger population with things in the ground, and it's potentially less risky.
All right, and the Reserve Bank will get the decision on Thursday, and then we will probably begin to get some sort of idea from the language as to where the plan is going to be for the next 6 months.
It's very clear that at this point it's not will they cut, but it's by how much, and that's the thing.
And how quickly.
And how quickly as well. That's the thing that we're going to be watching with, especially I will be, with a lot of anticipation, actually.
And the only thing that I see that may slow the pace of their cuts would be if how much inflation comes back into the system. At this point in time, the CPI data last week shows that it's not showing up just yet.
Yeah.
So that's the one thing that I could see that could slow the extent of the cuts.
All right, so roll on Thursday for the Reserve Bank's decision. Thank you both for joining us. Jason Walls from NBR and Sheldon Slabbert from CMC Markets with us on NBR Radio.
NBR Radio. Free to air online with business news you can use.
Let's talk Origin and Contact. New Zealand sources say reports from Australia that Contact Energy's 53% shareholder Origin is close to deciding on a sale of the stake may be premature. Potential investors were being sounded out in Australia and Hong Kong by investment bank Macquarie Capital, according to The Australian, while the Australian Financial Review said the format of a transaction had been nutted out over the weekend. New Sydney firm Luminous Partners, created in February by former Caliburn and Greenhill partners Ron Malik, Simon Mordaunt and Jamie Garris, is reportedly advising Origin on what to do. Mr Garris told NBR he could not comment on client matters. However, with an August 3 deadline for a decision on the Tiwai Point aluminium smelter and Contact not due to report its annual results until August 17, potential investors may be unlikely to commit just yet. One market source said it's a tricky time to put a stake out to the market. Origin had shown itself a patient investor in Contact over the years and was unlikely to rush into a sale while conditions were uncertain. He said a sale price of $4.50 a share, as speculated by the AFR, would be very disappointing for Origin. Contact shares were trading near $5.10 today. Another source said while it would make sense to test overseas investor interest since the New Zealand market would struggle to absorb such a large shareholding, at low prices a sale might not fulfil Origin's needs. The Australian company is committed to retaining an investment-grade credit rating, downgraded to BBB- by Standard & Poor's on April 22nd. The rating relies on Origin's ratio of debt to operating earnings, and with Contact contributing to the earnings side of the equation, a sale makes sense only if it can move the debt side of the dial enough to offset the loss of earnings. The source said there will be quite a bit of gamesmanship going on, referring to investment banks making a play for particular deal structures. It's understood that New Zealand institutions have yet to be contacted about their interest in Contact, but they are likely to be keen. Origin fueled speculation about a sell-down of Contact in a May presentation, describing asset sales as among its options to improve balance sheet flexibility. A special dividend payment by Contact in June, which used up imputation credits that could be lost in a change of control, was also seen as a pointer. Origin told media last month that Contact continues to form a key part of our Australasian energy markets business. To the outlook for our dollar, the New Zealand dollar may advance this week as the Reserve Bank disappoints some traders positioned for an aggressive interest rate cut of 50 basis points by limiting its reduction to a quarter point. According to a business desk survey of 11 currency advisors, the Kiwi may trade between 63.5 US cents and 67.05. 6 expect the Kiwi to gain, 4 bet it will fall, and 1 says it will remain little changed. It recently traded at 65.22. The local currency dropped sharply last week after a slump in milk powder prices at the GDT auction fueled calls for the Reserve Bank to cut interest rates more aggressively to prop up the country's biggest export sector. Traders increased their bets for the Kiwi to decline after some economists said there was an outside chance the central bank could reduce the benchmark by 50 basis points this Thursday, although most say they expect the rate will be reduced only 25 basis points. IG Markets chief market strategist Chris Weston said people have positioned themselves with the Kiwi for the RBNZ to become very aggressive. My personal belief is that they will cut by 25, and markets are pricing in a small chance, a 12% chance, that we get 50 basis points. They won't cut by that amount. He said, if they adopt a wait and see, let's see how things play out now, given what's happened with dairy prices and milk prices, then I think people will look to cover some of those short positions. The central bank last cut interest rates by 50 basis points following the Christchurch earthquakes more than 4 years ago. Mr. Weston said a 50 basis point cut would be a sign of desperation. I don't think they'd want to do that. I think they would rather do back-to-back than cut 50 basis points. I think that would send a pretty startled message to the market. While the longer-term trend for the Kiwi is a decline, Mr. Weston said there is a lack of major economic data out to drive currency lower this week. New Zealand has June data for immigration tomorrow and trade on Friday. Those expecting the Kiwi to decline pointed to a risk of a 50 basis point cut and a dovish statement from the Reserve Bank. In Australia, the Reserve Bank releases the minutes to its last meeting tomorrow. On Wednesday, Reserve Bank of Australia Governor Glenn Stevens is scheduled to speak in Sydney to the Anika Foundation, and data is released on second quarter inflation, while a business confidence survey due Thursday. The US is scheduled to release housing data and manufacturing gauge this week. In the UK, the Bank of England releases the minutes to its last meeting, and June retail sales are due out. In Europe, Greek banks are set to reopen today, though capital controls remain in place. European consumer confidence is scheduled for release, as well as manufacturing gauges. To Christchurch, contractors working for the Canterbury Earthquake Recovery Authority, or CERA, have nearly finished demolition of the new West End building. The West End building was the first to be rebuilt after the 2011 earthquakes and an early symbol of the rebuild. New Zealand taxpayers via the Crown have paid $3.75 million to buy the property. The cost of demolition is $98,000. But the good news is doors, windows, bathrooms, timber framing, kitchens and the screw pilings will be recycled, according to CERA. The concrete will be used as reclamation landfill by Littleton Port. The removal allows for road widening to give pedestrians and cyclists more priority along Manchester Boulevard. They'll be able to enjoy the unimpeded view to the east of the boulevard, which is a huge swathe of green space. Fletcher Residential was recently named as preferred developer of the area with plans to build apartments. The final deal is yet to be signed, and Fletcher will complete one building at a time as the market appetite allows. The east frame is part of the plan to shrink the central business district. Meanwhile, the cost of CERA's public relations will be between $1 to $1.5 million for the 2015 year. Local commentators have questioned the amount spent given CERA's poor communication. This is also evident in the way CERA withholds information from media. In August 2012, NBR sought the business case for various rebuild projects. 3 years later, the Ombudsman is still working through NBR's complaint about CERA's refusal to provide the information based on commercial sensitivity.
NBR Radio with Hotel de Brett, your home away from home, but with better service. NBR Radio.
Let's talk taxation. EY Executive Director David Snell says Inland Revenue is driving some otherwise viable businesses to the wall through its current regime of charging both interest and penalties on unpaid taxes. As well, Mr Snell says the tax department is building a probably fictitious asset of more than $6 billion in overdue tax on its balance sheet. Currently, IRD charges 9.21% on overdue tax and a penalty of 1% as soon as tax is overdue, then another 4% after 7 days, and then another 1% for each month the tax is outstanding. Mr Snell says all of those penalties compound to around 27 or 28% per annum in the first year on the core tax. He says we don't see that as necessarily encouraging compliance. Once a business gets into trouble, it's so much easier to just ignore the letters that come through. Potentially, he says, the penalties and the use of money interest compounding on the core tax can push businesses that may otherwise have been viable over the edge. Mr Snell says he has no truck for businesses that don't pay their tax and that businesses should pay their tax on time. He says it's difficult to work out how much tax debt is written off because IRD only reports the net figure after write-offs each year. But he says what it does report suggests much of the unpaid tax debt it's reporting can't be recovered. The department's latest annual report shows overdue tax debt rose 4% to $6.2 billion in the year ended June 2014, and $3 billion of that was penalties and interest on the original tax due. The report also shows overdue debt that's more than 2 years old nearly doubled from $2.26 billion in June 2010 to $4 billion 4 years later, or nearly two-thirds of the latest total. Mr Snell says most of that $4 billion is penalties and interest, and that doesn't bode well in terms of recovering that money. He said, why pile on penalties and interest and put it on the books when you're never going to collect it? While Australia also charges a high interest rate on overdue tax debt, currently 9.15%, it doesn't impose penalties on top of that. Mr Snell says both countries charge such high interest rates because they don't want their tax systems to become the lender of last resort. Some of EY's clients have built up situations where they owe more in penalties and interest than their original core tax. One client, for example, had a mental breakdown and didn't pay tax for a number of years, piling up a debt of about $300,000. Mr. Snell says the IRD did eventually remit most of the penalties in that case, but it took a long time. Mr. Snell's comments come on top of the Labour Party's new tax policies, which include a pay-as-you-go option, abolishing late payment penalties and doubling the threshold at which businesses are required to pay provisional tax. Mr. Snell says IRD is well aware it has a problem, and the government put out a green paper back in May aiming to change the law to make it harder for businesses to get into tax debt and easier to get out of debt. Let's talk tourism. A new survey shows Chinese travellers are younger, more independent-minded and tech-savvy, breaking a stereotype of cheap package tourists. The survey by accommodation booking website Hotels.com also shows these Chinese are increasingly cashed up and spend more on hotel rooms in New Zealand than any other country in 2014. The Chinese International Travel Monitor highlights the need for hoteliers to cater to Chinese travellers' needs, such as Chinese-speaking staff, Mandarin language tourist guides and dedicated websites. This country's largest hotel group, French-owned Accor, implemented a Chinese-centric hospitality program a couple of years ago, and Chinese interests are building Auckland's newest hotel project. The monitor provides detailed insights into how outbound travel movements by mainland Chinese are impacting the global travel industry. It combines data from more than 3,000 Chinese international travellers and 1,500 Hotels.com accommodation partners. One information nugget of interest to Auckland Council, which is planning to ban traffic from the summit of Mount Eden, is that this is the landmark Chinese most want to visit in New Zealand. It ranks 34th on a list of the world's top 50 tourism sites for Chinese. While New Zealand doesn't rank in the top 10 nations Chinese intend to visit in the next year, it comes in at a credible 13th, ahead of Canada. The top three countries are Australia, Japan and France.
NBR Radio, Monday the 20th of July. I'm Andrew Patterson, and with me, Callida Smiley. Callida, news that Nikko Asset Management New Zealand is looking to move into the retail space. Of course, they've been very strong and institutional to this point. What's brought this about?
Well, they've had a retail fund or a number of funds for about 3 years, but it's only in the last 18 months that they've actually expanded this. They've increased it about 200% in the last few months, last year or so, and a 300 million increase since December. They want to capture more of the retail market. They see that as where the market is going, along with KiwiSaver, and yeah, very interesting.
What did he say specifically would be the type of products they'd be looking to introduce into the retail market?
Well, they've got to focus on global equities, although I think they're going to have a look at domestic equities as well. They did say that they might be having a look at opening their own KiwiSaver fund as well. They currently manage funds for about 7 KiwiSaver providers.
I'm thinking the bulk of their funds probably come through AMAs and those sorts of sources.
Mm-hmm, yes, the authorised financial advisors, and they also are featured on the Rabo Direct platform, and I think they get a lot of their money through that.
Obviously, quite a tick up in interest around KiwiSaver, so therefore this in turn is driving opportunities for companies like Nikko Asset Management to get in on the back of that.
Yeah, I think people in New Zealand are increasingly growing more aware of managed funds and taking their investment out of, say, the housing market and putting it more into global equities or domestic equities. So I think anecdotally there's evidence, a little bit of evidence, that it's definitely increasing awareness in New Zealand.
And also one assumes the low deposit rates are probably enticing people into funds as well too.
That's right, and that's what Mr. Lin said, that, you know, with the low deposit rates, it's historically low, you'd be a bit silly to leave your money in that sort of space.
Did he give an indication as to how big Nikko felt they could grow, or what percentage of the market they expected to be able to capture?
Not what percentage of the market they want to capture, but they do have a 5-year goal to become 50-50 split between retail and institutional funds, and they wanted to get up to 5 billion in retail funds by March next year, which is that's their end of their financial year.
So a busy time ahead for them. Thanks for joining us, Calida Smiley, and this is NBR Radio.
NBR. With a National Business Review smartphone subscription, you can read or listen to the latest from NBR online. And for a limited time, it's free. Join NBR's Intelligent Business Network today and get free smartphone access to NBR online until August 31st. NBR doesn't do sport, weather or horoscopes, just timely, relevant, useful and insightful business news. So for business news you can use for free, visit nbr.co.nz/free.
I'm Grant Walker with Last Call. Here's what's trending on NBR Online. Sarah destroys near-new building. We tell you why. The services sector, the most buoyant in 11 months. School holidays and Netflix cause a problem for Vodafone. And what's the Kiwi going to do this week as we head toward the OCR announcement on Thursday? Plus, A2 earnings are flat and they say the buyout offer isn't good enough. To find out more on our stories, just log on to nbr.co.nz or maybe listen to it in the car. Stay tuned. Those stories coming up next on NBR Radio.
NBR Radio on Monday the 20th of July. I'm Andrew Patterson, and with me Rob Hosking taking a look at the economic and political week. Rob, all eyes on the RBNZ this week. Will it be 25 or 50, do you reckon?
I think they'll go for 25. They want to be sure that things are slowing down. And look, although we talk a lot about that awful dairy price fall last week, there is other economic data that says, look, things aren't necessarily slowing down that badly. One thing that I suppose might lead them towards a bigger cut is the fact they don't have to worry about inflation. And if you're looking at what's happening, not just domestically but globally, globally there is very, very little price inflation. Offsetting that, though, of course, is the New Zealand dollar is still expected to fall further, even though it has come down quite nicely. And, of course, that is going to push up imported prices. So they're going to want to be quite careful that they don't precipitate anything there. But I think the other thing which says don't rush into anything just yet or don't rush into a big cut is last year they hiked too far, too fast. And in retrospect, it would have been better for them in this very uncertain economic climate that we're in post-GFC. And, just as an aside here, but it is an important thing to remember, you have, post the global financial crisis, jolts which in the past, not just the domestic economy, but the global economy would have sort of taken a bit more in their stride. Well, they wouldn't have been jolts at all, they're just adjustments. But it doesn't take much at the moment for financial markets to take flight and for and not just financial markets, but for firms to go, whoa, I'm getting nervous here and I'm going to stop hiring, I'm going to stop investing. So they're going to want to make any moves, I think, as gradual as possible. So I think they'll do 25 points for this week, and it'll be a hold off. I think if they do a 50-point cut, it'll be September, because September as well is a full monetary policy statement. Now, what that means is they do a full set of updated economic forecasts. They have a full press briefing. They talk to MPs at select committees and things like that. Whereas this Thursday's statement is just that. It's a one-page statement, and there's no sort of press conference or anything like that.
Do you think there'll be any consideration given to the Auckland housing market, or is that a sideshow in the context of everything else that they're having to deal with at the moment?
The Auckland housing market is never a sideshow, ever, unfortunately. Yeah, no, look, it is. There'll be words, I think, in there about the Auckland housing market. But the other thing I think they'll be wanting to wait and see what happens is, as far as the Auckland housing market goes, is firstly there's the government's changes to tax and what isn't a register but is a roundabout register, which is the requirement for offshore investors to set up a bank account and pay withholding tax and register the ID. But the second thing here, I think, is that the Reserve Bank's own loan-to-value ratio rules, which come in October, and those which are aimed at property investors needing a bigger deposit. I think they'll wait and see, if that is starting to shift behaviour before they do anything precipitate. There are a number of factors here playing on the Auckland housing market, not just the official cash rate.
And speaking of which, of course, Parliament back after the school holidays, and it's the first opportunity Parliament will have to debate the Phil Twyford announcement and the issues around Chinese surnames as being a guide to who's buying Auckland property. What's been the fallout, do you think, for Labour? Because it seems they have been somewhat castigated for the stance they've taken. Has it damaged them or has it been enhanced them?
Look, I don't think the issue's gone away, even though the polls that came out last week, and in particular, the Roy Morgan one, which is on Friday, only covered part of this time, firstly, and second, the Roy Morgan one does tend to be quite volatile. The Colin Brunton one on last night on TV, the TV1 Colin Brunton one, that was a little bit more interesting because that's a very measured poll. It's one that personally I rate very, very highly. And it did cover the entire period. And you saw 1 point rise for Labour, 1.4 for National, which is margin of error stuff. I think, look, this is a live issue, despite that poll, because offshore money is a big factor in the Auckland housing market. I think where Labour went very, very wrong was firstly the main thing they did wrong was to make it a racial issue. And I know some people say, oh, it's not a racial issue, and blah, blah, blah. Sorry, I'm not buying that. If you're going through an electoral roll and looking up surnames and calculating their ethnic origin based on those names, then that's a racial issue. And really, if Labour didn't want to make it a racial issue, then they shouldn't have raised the issue of race. I mean, it's actually not that difficult a principle to grasp. There is an issue. And it's a big one with offshore money, but it's not just Chinese offshore money, although that I've no doubt that's the biggest part of it. We're in a world at the moment where there is low interest rates. It's very risk averse. So smart money around the world is looking at, firstly, property investment because it tends to be safer, and property investment that makes a good return. And that means, therefore, that they're looking for areas which already have fairly tight property markets where things are and where things look like being constrained in the future. So the money is pouring into places like London, like New York, like Sydney, and like Auckland. And it's certainly, if you're an investor in Europe at the moment, you're probably looking around the Eurozone and going, what the hell do I invest in here? Because, that place is flat for the next decade overall. So, and if you want a safe investor, if you've also got the aging population in these countries, they are looking for safe investments for their retirement. They're looking to a lower risk profile. Property market, it's a biggie. So you can talk about all those things without raising the issue of race, and they screwed that up big time. And I think it's a double whammy for Labour because it's not the Labour Party is kind of the people who are attracted to the Labour Party tend to be kind of anti-racist. And not in a minor way. It's kind of a big deal with them. It's a big part of their identity. And you've now got their own party saying this sort of stuff, and it's absolutely demoralising for them.
It was a kind of a half-baked attempt, wasn't it, to get it? I mean, it certainly got the headlines, but it ended up getting the headlines for all the wrong reasons.
Well, bird flu got the headlines, Yeah. It did get the headlines. And look, I thought it would work better than it did. And I've no doubt at all that, as I said, this issue is still live, and there is a anti-Chinese feeling in Auckland. I don't think there's any doubt about that, but I think it is somewhat misguided. You've got to wonder about a political ploy which Labour embarked on, which Winston Peters looked at and decided the data was too dodgy for him. And, I would say if Winston Peters thought this data was too dodgy to build a case around, that's, Winston Peters has a great track history of taking some very marginal stuff and turning it into a crusade. It's just, the sheer incompetence of this, and as well as the lack of principle, is just, takes the breath away.
The part of all of this that I don't get, Rob, is why not just have a simple register? I mean, it doesn't seem to be any more complicated than getting some basic information and making that available? Why this reluctance on the part of the government to do what seems obvious?
I don't know. And the only reasons I can think of, you've got to speculate as to why. One is perhaps they are concerned that it is going to be more than they can cope with in terms of what the information that comes out of it. There are some issues perhaps with international reputation, things like that, around being seen to be anti-foreign or whatever, when we are trying to attract the right sort of foreign investment in certain areas, certainly. And if foreign investment comes here, if we did something like the Australians and said, right, well, you build houses, well, I think in principle that's a great idea, but I think the problem, a lot of people have talked about that, but I think the problem is you've got to free up the land so we can build the houses, and although things are moving now, that's taken a number of years. The other thing, if you want to be cynical about it, the big party donors, aren't they? Quite a number of migrants, and I suspect, unfortunately, I think there is probably an issue there.
Yeah, because, small countries have to think about these issues. I guess for bigger countries like Australia, perhaps it's a smaller percentage. But to me, it just means that, or suggests that having a greater level of transparency with the data means that everybody can understand what in fact is going on, because the variance between what Nick Smith is saying at about 1% and Labour's saying it's somewhere around about 20% is obviously very wide.
That's a heck of a range, yes, and I suspect Nick Smith is on the low side. I find that a little difficult to believe, but again, I suspect that you do have, and it comes back to what I was saying before about people looking for safe havens for their investments. There's 1 million New Zealand passport holders live overseas. And if you're in your mid-40s and working in New York or London or something like that, and starting to look at where maybe an easier lifestyle, then you're probably going to a property investment back home probably isn't a bad idea. I very strongly suspect that. See, this is the thing. When you are you going to how do you define who is a foreign investor? Because there will be people overseas who are non-resident New Zealanders, so they're not sort of part of our tax take, as it were, but they're Kiwis, and this. But in principle, I agree 100% with what you're saying. I'm all for more economic data. The more the better. I love this stuff.
The other part of it, Rob, of course, is that the continued fall in the Kiwi dollar only exacerbates the problem, doesn't it?
Yeah, potentially. There's given the sheer volumes of investment going on in this area, I suspect it won't be a big one. But the Kiwi dollar, whenever the dollar shifts in the way that it has in the last 6 months, really, you see all sorts of shifts going on, and and they're not all good, they're not all bad. The dollar is going through an adjustment to reflect, in particular, but not exclusively, the dairy price. And we have any number of other economic factors which are sort of pointing in different ways. The services sector data out this morning, and that includes tourism, which is still our biggest offshore funds earner, is still in very, very large expansion mode. That was a phenomenal figure this morning. The release came through just about half an hour ago, and it's given the other data we're seeing, particularly in mood, I would have expected that to fall a little bit, but no, it's up. And like I say, the services sector, the biggest part of that is tourism, and they're going like gangbusters.
All right, Rob, we'll leave it there. Thanks for joining us for our preview of the week in politics and economics on NBR Radio.
NBR Radio with Bayleys, New Zealand's leading commercial real estate company.
In market news, Augusta Capital, the listed property investor and fund manager, has bought industrial property in Australia's Brisbane, which it plans to offer through a syndication later this year. The company said in a statement it entered an unconditional agreement to buy the Willawong site for $10.66 million Australian dollars and will lease the location to coatings and chemical manufacturer Akzo Nobel for an initial term of 8 years. The deal is expected to settle on December 1, and the purchase price represents a yield of 7.14% before stamp duty. Augusta plans to raise $6.75 million Australian in a syndicated offer of the property to investors, which will probably open in September. Last year, Augusta bought property investors KCL Property and Investment Property Titles for a combined $15.4 million in cash and scrip, giving it about 165 properties to manage, with some $1.1 billion in funds under management. Augusta shares last traded at $1 and have increased 3.1% this year. To our current account deficit, despite New Zealand's credit rating looking pretty stable, global rating agency Standard & Poor's says the country's current account deficit is poised to increase. S&P Australasia's sovereign analyst Craig Michaels says investment-heavy economic growth is putting pressure on the country's current account. A current account deficit reflects the difference between national savings and national investments in capital. So a deficit reflects the amount an economy is borrowing from offshore to fund capital investment. Mr. Michael says if New Zealand spends more on capital, it will need to borrow more from offshore to fund this unless it reduces consumption to lift domestic savings. He says added to the mix now is the fall in the terms of trade driven largely by dairy, which is also working in the same direction to put pressure on the current account deficit. The country's terms of trade rose 1.5% in the first 3 months of the year as a slump in imported petrol prices offset weaker prices from dairy exports. Although this halted 2 quarters of decline, New Zealand's terms of trade still remain historically high. Mr. Michael says from an economic perspective, the fall in commodity prices is dampening growth and will continue to do so for some time. This follows dairy product prices plummeting at the global dairy trade auction last week, with the overall index down 10.7% and large declines for almost every product. Almost immediately, the forecast payout for milk solids was slashed, with ANZ saying it now expects a figure closer to $3.75 to $4 per kilogram of milk solids. Mr. Michael says the risk from a macroeconomic point of view, if there is another bad dairy season in a year's time, it will create more pressure. He says, notwithstanding that vulnerability, we see a number of key strengths in New Zealand we think will make the economy resilient to a large degree to those external shocks if they should occur. He says New Zealand benefits from having a flexible exchange rate which will cushion the impact of an external shock. Mr. Michaels says New Zealand's central bank also has a high level of credibility in controlling inflation and has effective monetary policy tools, which in our view gives it a lot of flexibility to support the economy in the presence of a shock as well. Asked how likely it is that New Zealand's AA sovereign credit rating will be altered, Mr. Michaels says there is less than a 1 in 3 chance of it changing. He said we see the credit story as looking quite stable. In property news, another Queenstown waterfront section in bankrupt Auckland developer Nigel McKenna's Kawerau Falls development is sold for $6.2 million. The deal was initially reported by the local paper Mountain Scene and subsequently confirmed for NBR by Bailey's agent Greg Ross. Mr. McKenna's ambitious development vision was felled by the global financial crash in 2008 and was placed in receivership. 2 Hilton-managed hotels were completed, plus an apartment building, and much of the remaining land sold to Winton Partners more than a year ago for $10 million. Instead of a cluster of hotels and apartments, the site will now include a number of residential sections. The $6.2 million, 3,699 square metre block was sold to a local investor who plans to build homes on the site. 2 other large blocks are still for sale, one of them which has been divided into 56 residential lots, with 23 sold by Cam Reid of Ray White. The sale of this block hit a snag when the neighbouring Hilton Hotel filed for judicial review of the non-notified resource consent. The parties are understood to be negotiating. Tenders for the 3,763 square metre site zone for hotel and apartment development close on August 27. Meanwhile, a long-running court case over the fallout from Mr. McKenna's initial involvement continues. His original proposal was for 13 hotel and serviced apartment complexes, restaurants, cafes, bars and shops, and associated amenities covering the entire site. Stage 1 of the development included 2 buildings, Lakeside West and Kingston West. Lakeside West was to be a luxury residential apartment complex. Kingston West was to be serviced apartments operated as a 4-star hotel. Mr. McKenna formed development companies for each building, Peninsula Road for Kingston West and Kingston Road for Lakeside West. Mr McKenna engaged Singapore-based WN Singchi to market Lakeside West and Kingston West to Asian buyers. In 2006, Ostpac, a company associated with Mr UN, entered into marketing and underwrite agreements. The company failed to settle, and in 2011, receivers of Kawerau Village Holdings served settlement notices on buyers introduced by Ostpac as well as Ostpac itself. Kawerau Village Holdings cancelled the agreements to sell the units to Ostpac because of the failure to settle, and then sued Mr UN under his guarantee of the underwrite agreements. The statement of claim seeks judgment for $56 million. In the latest chapter of the case, Mr UN offers various defences. The High Court made several orders for discovery ahead of a further hearing.
NBR Radio. Free to air online. NBR, the meeting place of intelligent business.
NBR Radio on Monday the 20th of July. I'm Andrew Patterson and this is Ask Me Anything. Our guest today, IRD Deputy Commissioner Greg James. Welcome, Greg.
Thank you, Andrew. Good to be here with you today.
Our first question comes to you from Chris Keel, NBR Technology Editor and Head of Digital. IRD's business transformation project is estimated to cost $1.3 billion to $1.9 billion over 8 to 10 years. A lot of people struggle with that much money in terms of how it can be spent on a software upgrade. Rod Drury, of course, has famously called it obscene. Can you help us by breaking down how much money will be spent on software licensing, how much on software development and implementation, and how much on consultancy?
So at this stage, Andrew, I can't give you any of the specifics, but what I can tell you is that we're currently going through a major reforecast in terms of the outlying costs for the transformational journey. It's fair to say that our estimates, as we've signalled to Cabinet at this point, are certainly at the bottom end of the range, and we're currently working through those. In terms of the split, basically, I can give you a view that the IT component, which is a part of the program, and I'll probably pause there for a second and just refocus the discussion to ensure that your listeners are aware that this is not first and foremost an IT project. It is a business transformation project and program which will completely change the way Inland Revenue operates and interfaces with its customer base and with the government. So its first direction is business, and obviously a large component of that is also to ensure that this is successful is a technology component. And recently we've announced the partnership with Fast Enterprises, who we've selected as our preferred for the core tax and social component of the program itself. So roughly we're looking at probably in the vicinity of a third, depending on what the ultimate number is, a third on technology, a third on some of the underlying infrastructural elements, and then a third around the change components. But we're currently working through that.
How much have you looked at the preferred suppliers' credentials, given obviously the experience of NovaPay, which is very fresh in everybody's minds?
Yes, we went through a very extensive process in terms of the evaluation for our preferred supplier. We started the process back last year, went through quite an extensive request for information and then a request for proposal from the parties that we had down selected to, of which Fast was the selected preferred. We've done a lot of research in terms of what's available on the marketplace for applications off the shelf in this space. And we've researched a number of the customers that they've implemented into and implemented successly.
What about the issue about the fact that every major software upgrade in the history of mankind has come in over budget? We're all familiar about the factors at play here. Providers who are overly optimistic when they pitch, clients too keen to believe the hype, clients, of course, who keep shifting the goalposts, and a failure to streamline an organisation's systems before a major upgrade. How concerned are you, given the scale of this, that this will end up simply being another casualty of that process?
So all of those components that you've mentioned are front of mind for us every day. You mentioned NovaPay, and I think you've also mentioned Insys. So they're projects and programs that have had obviously some checkered past. We've spent a lot of time researching the problems that they encountered, and we've put in place a number of mitigation strategies to ensure that we don't go down the same pathway. We have, if you go back to the NovaPay situation, I think it's well known now that there was no view to simplify the very complex teacher payroll processes and systems that were out there. We've taken a path here with the transformation program to have a look at our policy, our legislation, to ensure that we take the opportunity to simplify the policy and the legislation so that we can actually make this a lot more simple, a lot more certain, and a lot more open for our customer base. The other key point that I think differentiates us to an extent from a number of the other programs that have had significant problems is that we have invested significantly in the right people, the experience of people that have done this previously, myself included, and a team that we've onboarded that sits firmly as Inland Revenue folks in this transaction, making sure that at each step that we are focused on the fact that this is a very complex transformation with a fairly significant risk base, but that is something that we manage daily, weekly and monthly.
Also from Chris Keel, Rod Drury has suggested you could save $500 million by, among other things, sticking to back-end systems or behind-the-scenes stuff. Rod Drury says that private companies should build the front-end or the web-based software that taxpayers use to interact with IOD. You've said you want IOD upgraded system to work with software providers like Xero and MYOB, but really that's nothing new. Of course, APIs have been used to let software programmers talk to each other for years. Will you go the whole hog and leave the client-facing side of things to private enterprise? And when will you make that decision?
Our intent is quite clear, and we've been publicly commenting that we are in discussions with Rod and Tim Reid from MYOB and a number of the other software players in New Zealand. So our intent is to definitely use the broader ecosystem effectively. We would expect that there'll be some announcements within the next week, which will probably be the first cab off the ranks for us in terms of how we join that broader ecosystem up with the Inland Revenue. In answer to your question in terms of how far can we go, we really do want to push the boat as far as we possibly can. We will be looking at what elements of business tax we can work through with the accounting software professionals. We'll also be looking very much in the payroll area. We're currently working with a number of the payroll providers. We're also conscious that there are a number of players in New Zealand that don't have access to or don't use currently commercial accounting software systems. So we're currently working on some strategies that will see us being able to either through Inland Revenue or collectively with the industry, provide some mechanism for those folks to access more streamlined and cheaper digital services.
How collaborative is the approach that you are taking versus designing a system that will simply be imposed on the market?
We think it's very collaborative. That's probably a good question for you to pose with Rod and the guys. But we're working extensively. First and foremost, we're looking at GST, so we've narrowed the field down and we're working with the accounting software professionals. Once we've got those plans in place in the short term, then we'll start to broaden it, as I said, with the payroll companies. But it won't just stop there. We'll also start, once we move into the next stage of this program, we'll start coordinating and collaboration with the banks, the mainstream banks, and the other financial institutions where withholding naturally applies today. We think there's some real opportunities, not just to simplify and make it more certain and more open for our customer base, but we think there's also service opportunities going forward for organisations to look at a different mix and a different type of services in the next 5 to 10 years for the customers.
You've mentioned that this is a transformational project. So if we think it at a high level, what are the primary objectives that you are seeking to achieve as a result of implementing this new system?
So at a high level, our stated aim is to make the future tax and social policy system simple, more certain and more open. Our stated aim is to ensure that we do not move the compliance burden from the public sector onto the private sector. So we need to do this in a way that's equitable, in a way that enables us to unlock huge efficiencies that we believe exist in what is today's tax compliance burden, if you like, because it's a fairly significant cost as part of a business operation. We also know that the burden is regressive, so it hits the smaller companies more than the larger companies, so we want to unlock that opportunity and provide either time or dollars back to those businesses to get on more productively from a New Zealand Inc. perspective.
Have you had an opportunity to look at other countries that have gone through this process?
Yes, we've spent quite a bit of time researching our neighbours across the ditch. We have a very close relationship with the Australian Tax Office. We've spent time with Singapore. We've spent a lot of time in Europe just understanding where various jurisdictions are heading. And similarly, we spent a fair bit of time having a bit of a look at the US system to see what opportunities or similarities exist there.
Is there any one country in the world that's deemed to have the most efficient or the Rolls-Royce equivalent of a tax system from an IT perspective?
It's a really interesting question. When I came into this role, I'd assumed that there would be some degree of consistency, but my findings have suggested that whilst tax is a common thing, and some have said one of the certainties in life, the way each jurisdiction goes about their tax policy and their tax legislation tends to be quite different from what I'm seeing. So we're seeing instances of jurisdictions that are leading the field, if you like, in certain areas, whether that be in digital mobility, whether it be in a joined-up government sense, etc. But no one that you would cite as the pedestal that you'd be striving to achieve.
So are you hopeful that New Zealand might end up with that mantle eventually?
I think we are, actually, from what we can see. In fact, we had a tax conference last year, and one of the things from the international speakers was quite clear that they rate our broad-based low-rate tax system in New Zealand as absolutely world-class, particularly given the demographic and geographic nature of our country. And we believe that we can aspire to be even better than that. So a lot of jurisdictions would love to have what we have today. We want to go one step better, and we're quite convinced that we can.
Well, what about future-proofing the system, given that we know that every government comes in, wants to change policies and adapt it? How will this system be able to adapt to changes of policy in an efficient manner in a way that perhaps it can't at the moment?
Well, one of the other lessons that I've learnt is that we are here to serve our governments, and yes, you're right. Policy and change is one of those givens in terms of this situation. Today, as you well know, in terms of FIRST, it's served us very well. Our mainframe, it's huge, it's complex, it's very stable currently, and we're keeping it that way until we can obviously replace our technology layer. But one of the key drivers that we've looked at as part of our selection process is to ensure that our future partnering and the organisations that we partner with do provide us with tools and technology that are agile and able to be adapted. Our current view would suggest that where we're looking, we believe that the new technology options that we will put in place over the next few years will give us a marked improvement in terms of our ability to meet government demands, not just in terms of the time frame to deliver, but also in terms of the investment dollars required to be for that delivery.
Other questions from NBR readers. Are there plans to introduce a single customer number and address database for New Zealanders to register at and maintain Real Me on steroids, if you like? It seems like a great opportunity to coordinate and cross-check services being provided by a whole range of government providers and enable services to be far better find and target those in real need, let alone make our entire government machine more efficient and seamless and, dare I say, help prevent fraud. Do you agree with that?
Well, I think it's a really good question, but it's a question that has a huge amount of complexity when you distill it all down. The whole concept of having one primary identifier, you then start getting into the issues of privacy, and you get into the issues of Big Brother and all of those personal type elements that come out of that type of situation. So, I mean, undoubtedly, if you look at some of the international models, the countries where they have that, they're certainly able to expedite a number of improvements in digital information sharing in both the social area and in the criminal area, and also in the tax area. But I guess that's a better question posed to the current government as to whether they have an appetite for that type of legislation and policy.
Question from Dave Lane, who is the co-founder of the New Zealand Open Source Society, around open source. I understand there's a bet going between you and he about the fact that he's claiming that by going down the off-the-shelf route, you're going to fail spectacularly. Open source would be a better way to go. What are your objections to an open source model?
Well, actually, I don't have any objections to an open source model. There is a relative place for open source, and we will test the boundaries of that, particularly in a couple of areas. We'll look at it in the areas of mobility, and we'll probably also look at it in the areas of information and information exchange, analytics, etc. However, when it gets to the core, that core heart that pumps out $60 billion worth of Crown revenue, which underpins the New Zealand economy, the risk appetite there is such that we've decided to go for a tried and true solution. So comfortable that open source has a place to play, and pretty confident now from where we're at. I'm also confident to increase the size of the bet if there is a willing taker on the other end.
Okay, from Wayne Austin, is there a set percentage of your upgrade project that will go to local contractors? If so, what is it?
Yeah, we don't, under the government rules of sourcing, we can't specify New Zealand across anybody else, but the reality is that where we're sitting currently is about roughly about 60% of our work is with New Zealand companies today. And more than half of that is with SMEs. We would expect going forward that there is always going to be a place for New Zealand-based services and product as we go through this journey. We will be, for the industry, to take note over the next few months, we'll be sounding the market out in a whole raft of areas outside of the core, but areas that we need for a complete picture for inland revenue going forward.
Wayne also asks, somewhat obviously, people are doing more and more on smartphones and tablets. How has this been factored into your upgrade plans?
Yeah, absolutely. It's at the heart of our plan. Our key driver is customer experience, a key drive to move more away from some of the existing paper channels to digital. We know we need to do that by going and investing more in mobility. But we also know that we have a customer base that is now used to dealing with other service organisations, and they require the same service, the same level of service from us as they would from a bank. So it's front of centre, front of mind for us, yes, absolutely.
From Guy Daniels, we touched on this a little earlier in this discussion around your consultation with the private sector. He asks, what advice have you taken away from the meetings that you have had with private sector representatives?
So very interestingly, and if we go back to the NovaPay and the INSYS examples, we've also tested a number of what you'd call troublesome programs overseas, both in the public and private sector. And the advice that we've taken away is to make sure fundamentally that we first and foremost have the experience internally within Inland Revenue to drive something of this scale and of this complexity. Make sure that you have people that have the requisite skills, that have done this on multiple occasions in the past, that know where the pitfalls are, and know how to manage and drive a program of this scale and magnitude. So that's been the key learn for us, and we continue to make sure that we run a very transparent process, which was the other message we found extensively, both private and public sector. Failures occur because people are not transparent on the journey. So we're running a very transparent process here, even within the government sector. You'll notice and I'd encourage anybody to go and have a look at our website. We have a transformational element on our website where we publish a lot of the information, including our quality assurance reports, etc. So, the best mechanism for us is to be kept absolutely honest in this, and it's to be transparent and make sure that we're all trying to solve this problem to ensure that we can deliver the best result for New Zealand.
And Gilbert also asks, Gilbert Anderson rather asks, after your upgrade is complete, will there be a place for those tax refund companies?
The real answer to that is no. We'll be moving to a real-time system. Our policy drive and our simplification is to ensure that if we're in a situation where a taxpayer is owed money by the government, then we would like to see that refunded almost in a real-time automatic way, and we're testing the legislation and the policy, so some of my comments are still subject to the appetite around that from a government perspective. But the reality is we're moving real-time, and we'll be looking to change a lot of the rules around that to simplify, make it more open and more certain for our taxpayer base.
Gilbert also asks, who's making the big decisions at each stage of the project? Do any members of Cabinet get a say?
Absolutely. At each major stage, we submit what we refer to as a detailed business case. That business case identifies, obviously, the costs, the benefits, and what we're undertaking and what we will deliver. That business case in itself goes through a very robust set of checks and balances within the central agencies model within government, and then it goes to Cabinet for final sign-off. So very extensive. We also, just on that, we have a very effective internal governance set of governance processes, and on the internal governance process, we have external members that we use to check and balance us on the journey as well.
From Claudia, from a historical perspective, how long has IRD's current system lasted, and what do you expect the lifespan will be of your new upgraded system?
So the current system is 25 plus years old. You could probably say it's 30 years by the time they started first thinking of it. In terms of our view, we would expect the level of investment in the new reorganised, refined and new technology that Inland Revenue will be delivering as part of this transformation journey to last as long, if not longer. We will be expecting a good 25 plus years out of our new technologies as well.
From Matt, the IRS in the US was recently hacked with criminals gaining access to around 100,000 taxpayer accounts. How confident are you that IRD systems are secure today, and will there be a separate contractor for security working with you in terms of the upgrade?
Yeah, very confident. I should say I'm confident today. Very is probably a word I shouldn't use in this context because we're under constant attack. We are being spammed. We're being hit constantly. We're having to spend a lot of money to maintain our security today, and it's an absolute priority focus going forward. Will it be subject to a separate contractor? No, it's part of the total picture, and it's part of the overall delivery that will be part of the transformational journey.
Just give us a sense of how many staff you have working as part of the transformation team, and I assume it'll ramp up over time.
Yeah, at the moment, with our partners on board, today's partners, and the numbers I'll give you would include the FAST team when they land. We're probably looking at around about 220 to 250 odd people full time on the transformational journey. Now that's split across a number of dimensions. It's split across our policy stream. So as I said before, there's significant reinvestment in simplifying policy. It's split across our process stream in terms of the new business processes that we will be driving forward across both the tax and the social policy area. It's split across our organisational design stream. It's split across our data stream, and so on. So it's again, to repeat, not just an IT project that we're running here.
And what about the cutover? Are you looking to run a hybrid where you're running a bit of the new and a bit of the old simultaneously, or will the whole thing switch over on a famous weekend?
Yes, no, it's a bit big for that. And I think, as the Minister of Finance, Bill English, has said, we're not going to have heart surgery on day one. So what we have is we have a situation whereby we will be delivering the transform journey in small bite-sized pieces, so there will be chunks. We'll be focusing on things like GST first, and then we'll be doing employee monthly schedules, and then we'll be moving on to look at personal income tax and such like. So we'll be doing it progressively. As part of the journey, though, one of the things that we do have both an advantage and a disadvantage, I guess, if I look at the advantage first, we have FIRST, which is, as I said, been a Trojan, been a great workhorse for us, and we will take that on the journey with us, and so we will run a coexistence strategy. So as we bring on new, we will look to be able to turn off elements of the old where we can, but we will keep the coexistence going to make sure that we can maintain the integrity of that $60 billion each year that we need to collect on behalf of the government. What's the system going to do in terms of data analytics, which obviously is a big priority for the government and increasingly for businesses, actually understanding the data? What will it enable you to do in the future, perhaps, that you can't do now? There's a few things in terms of analytics and information that we get some real, real incremental or immediate benefits from as soon as we start to move down this path. What we will be doing is we'll be moving our compliance checking to the front of the transaction as opposed to it being more an after-the-event set of compliance checking. So we'll be able to run analytics to ensure that as we receive transactions, that they pass an effective compliance check mechanism. So we'll be able to also, with our new approach, understand the complexity of the relationships that exist both within the business domain and individuals' lives by understanding where all of the connect points are through both the tax and the social policy area. And we will also have the ability to within the privacy constraints that we have and within the constraints of the Tax Administration Act, have an ability to share the information that we're able to share by Act to other government agencies. So it's commonly spoken about the size of the black economy, somewhere estimated to be more north of 10%, depending on which number you take. But how much do you believe that you will be able to significantly reduce that figure over time? It's a great question and really hard to gauge. And there are various numbers floating around in terms of the hidden economy or the black economy, as you refer to it. Our focus really is on making the transaction as simple as possible, making sure that we collect at source, so withhold at source, and as such, we would expect to see an improvement in Crown revenue and a reduction in compliance costs. So there's in the vicinity of, and I don't have the exact numbers in front of me here, but there's the benefit cycle is around revenue uplift for the Crown, operating cost reductions, and the other financial benefits, and then the economic benefits are around compliance savings for individuals and for businesses.
And therefore, how much will it also be able to be interfacing with other government departments to reduce areas such as benefit fraud and so forth?
There's certainly opportunities there, and those opportunities will be worked through as the information sharing provisions are looked at, and where we have a memorandum or legislative ability to share that information. Under our current acts, for us to share any information with any other agency requires a legislation to be passed in Parliament. Unless it already exists, we would then need to go back through that process.
In the cases of independent contractors and businesses, obviously the system relies on a high degree of honesty in terms of the way that you fill out your GST forms and so forth. How much more able will you be able to, I guess, detect variance much more accurately than perhaps you can do at the moment?
Well, certainly with some of the new tools and techniques that we'll have, we'll certainly be able to see patterns a lot earlier. I think the other thing here is it then does take us back into the conversation around how can we work more in partnership with the likes of Rod Drury at Xero and Tim Reed at MYOB and others to ensure that we have access or we have access to information that they're holding on behalf of their customers from a tax perspective. But importantly, how can we actually make our collectively, how can we make the life for customers a lot easier? And I know that the industry is currently working on a number of things that will progressively be rolled out over the next couple of years, which are designed to make accounting and tax transactions an awfully lot more simple than they are today.
I know the transformation project is your key area, but I wondered if you might have a response to the criticism levelled by EY that IRD is driving some otherwise viable businesses to the wall through its current regime of charging both interest and penalties on unpaid taxes. Will the new system allow you, perhaps with the benefit of a higher level of technology, to take a different approach in some of these areas in the future?
I haven't seen the article that you refer to from the chap at EY, but certainly I can tell you that back to this whole area of simplification of policy, everything's on the table. We will be looking at all elements of the tax structures as we know it today, including what are the appropriate penalty regimes, what are the appropriate interest regimes, and how do they work. And I know there's a lot of discussion in the last week around things like business tax and provisional tax. That's top of mind for us. I think I'd draw your attention to the fact in our green paper on tax that we released a couple of months back. That was pretty much one of the topic areas for us, and we're working through that with the government now in terms of what are the next steps, how do we reshape this to make it a lot more simple, a lot more certain, a lot more open, particularly for the SME marketplace, so that we can help them become more productive and take time out of their, what would be for them, mundane accounting and tax issues.
A couple of final questions, one from Fernando. What's it like running a public sector project compared to your work at Telecom and previously Fonterra?
This is a lot more complex. I can categorically say that. The scrutiny here is unbelievable, and given that we're spending public money, there's a positive side to that. So we are under the microscope. I have a very diverse set of stakeholders. Where in my previous roles, I have a board, I have a chief executive, and I have some subcommittees here. I have that on steroids, if you like. So it's certainly a lot more complex. Regrettably, I think some of the large-scale challenged projects of the past have probably overemphasized the focus on risk from the point of view of not allowing people to necessarily get on in the most agile and adaptive way to deliver. So it's a major challenge, but all part of the job. So we work through that. We build the right sort of rapport that we can with the government, and fundamentally we just have to be completely on top of our game every day. There's no time for slacking in this one.
What sort of timeline are we talking about here?
The original estimates that were announced by the previous Minister of Finance, Peter Dunn, I think he announced around about a 10-year journey. Similar to the investment discussion, we're currently reviewing that. We have given some guidance that it's not 10 years, it's less. At this stage, we think quite likely that we could deliver somewhere between the 7 and 8 year time frame. And we're going to be pushing as hard and as fast as we can on a few fronts, really. One is we need to get out of this risk cycle, so we need to do this as fast and as wisely as we possibly can. The other key factor from my perspective is we need to be able to give successive governments in the future the agility back around policy, because today's world, with our first mainframe, it's a little bit constrained, so we want to be able to provide the agility back. And we need to do that prudently, recognising the amount of money involved here and making sure that this is successful.
Presumably your preferred supplier has penalty clauses and so forth inserted in the contract for non-delivery on time.
We're currently working through the contractual arrangements, and I won't disclose any of the individual clauses, but they're robust contracts that ensure that the government is protected.
Final question from Robbie: can you put your hand on your heart and tell us you've never paid a cashie?
Oh, now this is a worry for us. This whole cash business. I mean, we've recently, as you know, we've run some program out of Auckland, which has had some really, really good results. We're seeing fundamentally that when we survey most people, everybody believes that tax should be shared and that we should all pay our fair share of tax. So it is a focused area. It was an interesting question because I reflected on it and I looked at it and I went, well, actually, through my life, I've paid for things with checks, with credit cards, and with cash, and I've always received invoices for them. To me, the bigger question is, are those invoices being accounted for as part of the revenue for the company that I'm dealing with? And that's really where we want to take the focus of this system going forward.
Thank you very much for joining us today, speaking to IRD Deputy Commissioner Greg James, overseeing the transformation project at IRD, with us on NBR Radio.
NBR. Need to hire? Try our online recruitment platform, www.nbrtalent.co.nz.
Let's talk land. The end of developer Oliver Scott's dream of a Marsden city south of Whangarei has been sealed by a tender for the 83 hectares he aggregated at Marsden Point. In May, BDO Auckland partner Brian Mayo Smith was appointed receiver of the companies through which Mr Scott owns the land: NH Infrastructure Limited, North Holdings Development Limited and North Holdings Investment Limited. The freehold land is in 88 titles with resource consent to subdivide and is zoned for residential, commercial and industrial. A sealed roading network throughout the land has been completed, with preliminary infrastructure services laid for telecommunications and wastewater connections. The roading and stormwater system was paid for by Mr Scott through his companies and put in Whangarei District Court ownership after being signed off by engineers. But sections of the stormwater and wastewater systems on the multi-million-dollar development failed, causing pipes and manhole covers to slump. The council says the immediate costs of fixing the slumping infrastructure, which it blames on the acidic soil in the development, will be $5.4 million, while fully replacing the pipes will cost an estimated $12.9 million. The council is taking legal action against the companies involved in designing, building and signing off the scheme before council took ownership. Mr Scott had planned a development he believed could grow to a population of 40,000. Stage 1 of the development was to have had 22,000 square metres retail, 20,000 square metres commercial and industrial areas, 250 residential sections and 150 apartments above. His overarching vision for Marsden City was that businesses located in the eastern precinct of the land would not only be close to motorway access, but would also act as a sound barrier for the neighbouring residential sites. The east-facing ports of the site are zoned for residential development, either as larger lifestyle blocks or with some degree of densification if the additional subdivision consents are initiated. The land, which has gradually been developed since the mid-2000s, was first zoned for purely commercial and industrial uses, but a private plan change several years ago saw a portion of the land rezoned for residential development. One portion facing onto State Highway 1 was identified for a large supermarket and a neighbourhood convenience retail block with a multinational fast food court. There's been an increase in these type of hubs on the outskirts of provincial New Zealand cities in the past 4 years. Scott Kirk of Bailey's, who's marketing the property, says both of these options could be undertaken, as the business case for both are unchanged in terms of competition and population demographics. As the land is inland from the waterways and marina of Marsden Cover, sections at Marsden City are expected to be at lower levels. Mr Kirk says the per square metre rates for the land vary considerably between industrial or residential use, and that impacts on the upfront values, depending on what percentage of the land is allocated for which purpose. In market news, A2 Milk, which markets milk with a protein variant said to have health benefits, says annual earnings were flat and are set to triple in 2016, with sales expected to rise faster than forecast. Separately, the company has told its suitors to try again after an initial offer wasn't compelling and drew out rival bidders. The company said in a statement earnings before interest, tax, depreciation and amortisation was unchanged at $4 million in the 12 months ended June 30, and a forecast arrived to $12 million in 2016, ahead of plan. Annual revenue rose 39% to $154 million, and A2 raised its 2016 sales target to $267 million from a previous forecast of $230 due to growth in infant formula sales in Australasia and China, new product launches in Australia and New Zealand, and the company's launch into North America. It said the company considers that its budget has been prepared on a prudent basis and could reasonably expect performance to exceed budget projections if current trading conditions and trends in infant formula are sustained throughout the course of FY16. The A2 Milk Company continues to perform strongly ahead of its plan in its core ANZ business, which is delivering significantly increased profits and cash flow. Last month, A2 said its cornerstone shareholder, ASX-listed Freedom Foods Group and US food and beverage firm Dean Foods, were eyeing a takeover of the company, stipulating a planned capital raise didn't go ahead. A2 today said the offer put forward wasn't compelling and the board wouldn't be in a position to recommend it to shareholders if a formal bid was made. It said the board has advised Freedom Dean Foods that it's willing to have a discussion in relation to the EOI, subject to agreement on appropriate confidentiality and related undertakings customary in situations of this nature. The board has also received other confidential inquiries indicating potential interest in the company, as in the course of evaluating these. The company set up plans to fund its growth from cash flows in the first instance and has short-term debt facilities in place to support working capital needs. A2's Australia and New Zealand segment accounted for the bulk of earnings in the 2015 year, generating a 58% increase in EBITDA to $30 million on a 39% gain in sales to $149 million. The region is forecast to post earnings of $40 million in 2016 on sales of $216 million. Across China and Asia, A2's sales were flat at $3 million, while it reported an EBITDA loss of $4 million compared to a loss of $3 million in 2014. The segment is forecast to break even on sales of $13 million in 2016. The US and UK units doubled sales to $2 million, while trebling the EBITDA loss to $12 million in 2015. The two units are forecast to generate sales of $38 million for an EBITDA loss of $16 million in 2016. A2's corporate segment reported an EBITDA loss of $10 million in 2015, up from $8 a year earlier, and expects that to widen to $12 million next year. A2 said it repositioned its brand into the premium specialty category in the UK and downsized to a 1 litre package from 2 litres, which has improved margins. The company plans to introduce UHT milk and infant formula in the short to medium term in the UK. It said following the changes implemented during financial year 15, the company is forecasting a reduced funding contribution to the business in FY16.
NBR Radio, Monday the 20th of July. I'm Andrew Patterson. And a new generation of drinkers, both male and female, are changing the face of the international alcoholic beverages market. In his Editor's Insight today, Neville Gibson examines a new report by Rabobank, the Dutch-based bank that specialises in agribusiness lending. Neville, what are these changes that Rabobank has actually found?
Well, Rabobank issues quarterly reports on the global wine industry, and its latest one highlights the growth of a competitor category, cider. Its beverage analyst Mark Socio says the cider category has gone a long way to discard an old-fashioned image that it had, and it's connecting with a new wave of consumers. Among his findings are that there's been quite impressive growth in demand for cider outside of Europe, known in the wine business as the New World, and there's also a relative appeal to cider for the well-off younger consumers, both male and female, and they say, and he says that this poses a real threat to wine, and also that cider has been imitating the beer market, which of course has fragmented quite a bit with the growth of craft beers and also with premium beers. So he's saying cider's caught on to that, and the wine companies had better look out.
Yeah, interesting. I mean, cider's been around for a long time, but why has it suddenly become so trendy?
Well, it's largely this growth in craft beers, and also anyone who's interested in cider will notice that there's been a whole raft of different flavours, sizes, strengths, and so on. And the craft beer market, of course, everyone likes one particular type, and the range might be quite bewildering, but from a marketing point of view, this is just gold. And cider also has strengths and it's really rivaling the RTDs as well, the so-called alcopops. So it's quite a damning report actually on the lack of response by some to the sudden success of cider. And I must say it is being driven by some of the major breweries, but not all of them.
So how are the winemakers responding to this trend?
Well, they're not.
Yeah.
The short answer is they're certainly not being very innovative about new types of wine and so on, although they are having a crack at low alcohol wines that are aimed at, particularly at the lunchtime market and maybe among female drinkers who are more conscious of high alcohol wines. You know, you're talking about up to 14% for most wines, whereas low alcohol wines might be around about 9%. But no one these haven't really caught on. At the top end, cider might be at about 6 or 7%. I think anything above that, you're really getting into quite dangerous territory as a drinker. The other thing is that wine is really only available in one form, and that is a standard 750ml bottle. These are quite heavy, of course, and no one who's drinking by themselves or having a quick lunch is going to open a bottle of wine. And it's very hard to get those smaller, lighter bottles that you can carry around like you can with water and other beverages like that. And nor can you, if you go into a wine bar or restaurant, nor can you get it by the glass easily. You have to, they charge you quite a bit for open a glass of a bottle rather, whereas in a lot of places where cider is caught on, you've also got you can get beer out of good wine rather out of a cask, and that trend hasn't caught on here yet either. So
what's happening to wine consumption and production more generally?
Well, apart from giving marketing advice, the Rabobank report goes into quite a bit about wine consumption and production around the world, and it's found that the production has fallen quite dramatically right across the board. In fact, in New Zealand, it was down 27% in the 2015 wine harvest. Other countries to have big drops were Chile down 18%, Italy down 17%, and consumption has fallen by 1%, but production's fallen by 5%. So that's going to be quite a big challenge to the pricing of wine. Obviously, there's an implication there that wine is going to get a little bit dearer, and particularly in New Zealand for the popular varieties.
Now, exports are obviously important to the local industry. What's happening there?
Well, that's one area, bright spot. We're exporting more and more. There's more demand for New Zealand wine than we can supply. It's going to squeeze the domestic market. Sauvignon Blanc, of course, has already is the top wine, and they cannot provide enough of it. Pinot Noir is catching up, and Pinot Gris is also quite a strong one. One company, Gießen, recently, and this is very little news coming out of the wine industry lately, but it said that it's shown big growth in the American market, and the guy there reckons that the American market could be our largest single market, overtaking Australia within a year or so. Constellation Brands, which is one of New Zealand's 3 big companies, already is US owned and sells most of its production there. But others are hoping for big things out of China. That's certainly done quite a big thing for Wine Australia, which put out some figures last week to say that exports have risen in the year to June 30, up 5%. That's the first time the value of exports in Australia has risen for the past 6 years.
But look out for more cider potential to be consumed across the lunch table in the future. Thank you for joining us with this insight today, Neville Gibson on NBR Radio.
NBR Radio with Hotel de Brett. Open for breakfast, lunch and dinner and everything in between. NBR Radio.
To the services sector, New Zealand's services sector, which accounts for about 2/3 of the economy, was at its most buoyant level in 11 months in June. The BNZ Business New Zealand Performance of Services Index rose 0.1 to a seasonally adjusted 58.2 last month, its highest level since July 2014, and extending a run of continuous expansion since October 2009. All of the 5 sub-indices were above the 50 reading that separates contraction from expansion. The improved performance in the services sector comes after a similarly upbeat gauge of the manufacturing sector last week. The BNZ Business New Zealand Performance of Manufacturing Index rose to a seasonally adjusted 55.2, the highest level since February, with all components in expansion. Bank of New Zealand senior economist Craig Ebert said whether passed by region, industry type or firm size, every bit of the PSI was in expansion mode, which is rare. Combined with the improved PMI reading for June, the latest PSI paints a picture of an economy expanding robustly, probably a little better than average. The Performance of Composite Index, which combines the two measures, increased 0.6 of a point to 57.8 on a GDP-weighted basis and rose 1.5 points to 57.2 on a free-weighted basis, the closest the two measures have been to each other since December last year. Although the measures were buoyant, economists expect New Zealand's economic growth to slow as weaker commodity prices weigh on the country's main export and earnings. The Reserve Bank is expected to reduce the benchmark interest by 25 basis points this week to bolster the economy, with further cuts predicted before the end of the year. The latest PSI showed activity sales weakened to 60.2 in June from 62.9 in May, while new orders business edged lower to 63 from 63.1. Employment slipped to a reading of 54.2 from 56.3, while stocks inventories advanced to 53.4 from 50.5, and supplier deliveries increased to 56.1 from 49.9. To export earnings, Andrew Bassan, the Managing Director of Wellington-based funds manager Harbour Asset Management, says share market analysts are expecting a slew of profit upgrades and new commentary from stock exchange-listed exporters in the upcoming earnings season, following the recent slump in the value of the New Zealand dollar. Among likely beneficiaries are businesses such as Fisher & Paykel Healthcare, Newplex Industries, Xero and Diligent. He told Business Desk the Kiwi dollar is 15% lower than its average year to date. The local currency appeared to have reached a sustainably lower level against the Australian dollar, where it threatened to reach parity earlier in the year, creating major headaches for exporters to New Zealand's largest market for high value-added goods and services. Mr. Bassan said this is a fundamental change in the Kiwi dollar. This has major implications for revenue expressed in New Zealand dollars, for margins, profit and for valuations. While the lower Kiwi would have little or no impact on profits for the 6 months to June 30, companies would expect to give new profit outlook statements and analysts would produce new profit forecasts using exchange rates prevailing today. He said you're going to get a very big twist that's going to occur. Take a tech company like Diligent. It earns US $98 million. That used to be worth New Zealand $120 million. Now it's worth $150 million. Harbour Asset has built a 9.63% stake in Diligent, which sells and develops software for use in corporate governance from operations headquartered in New York, but is NZX listed. Mr. Bassan said no one has changed their Diligent forecast for a month and a half. It's happened so quickly. He said there would be a few companies such as Sky Network Television that relied heavily on imported material to resell in the New Zealand market, although most would have forward cover, so the impact on profits might be up to a year away. Eventually it comes home to roost, he says. The local share market had yet to react fully to the changed exchange rate outlook, in part because it doesn't know whether to believe this yet. He said it's like a slow option contract beginning to pay out. Looking out 2 to 3 years, and Mr. Bassan says it was logical to expect global dairy prices to bounce back to commercially sustainable levels, not just in New Zealand but around the world, at US $3.19 per kilogram of milk solids, which I think is the estimate using spot prices in a cash flow sense. I don't think there are many farmers that are making money. They stop making milk eventually. The stockpiles run down and the price goes up again. He said, expect dairy prices to rise again and maybe the New Zealand dollar goes down more first and then comes back up. In the meantime, the New Zealand economy would be hit. He said it may not be a recession, but growth falls and it induces the Reserve Bank to ease. So this plays out like a very slow tanker that's had to turn. Let's talk broadband, or lack of it. How were your school holidays? For Vodafone cable customers in Wellington and Christchurch, there was a risk of kids gone wild as Netflix usage surged 85%. Vodafone emailed customers warning the school holidays streaming video frenzy had glugged up its cable at times. That's not what you want to hear when you're trying to keep the little ones occupied. Some of the bigger kids on Geek Zone were complaining too. There's been a streaming video boom all over the show this year. Chorus has reported a stunning 40% increase in total bandwidth throughput so far this year on the back of the Netflix New Zealand launch, Sky's TV Neon going live, and Spark making Lightbox free for all its broadband customers. For a couple of months, Commerce Commission contracted broadband tester TrueNet reported major peak time slowdowns. The overloaded internet meant streaming video was slow or inaccessible during the evenings. But on June 30, TrueNet sounded the all clear. A combination of network capacity upgrades and more use of caching had resolved the congestion crisis. But then it fell to pieces for Vodafone customers in Wellington and Christchurch, or at least those on the HFC, or hybrid coaxial cable, or simply cable, network inherited with the company's $840 million purchase of Telstra Clear. In May this year, before the school holiday frenzy, TrueNet found Vodafone's cable service struggling at peak times compared to fibre and VDSL. TrueNet principal John Butt told NBR the technology has a big problem. He said we can see quite large changes in median speed from every one of our panellist connections from 100 megs per second during the day down to under 20 megs per second at evening peak time, and for some panellists their median speed dropped down to 5. But why is Vodafone's HFC cable having such a hard time coping with Netflix-induced surges in demand? Well, Mr. Butt says cable upgrades are a much bigger problem when responding to a sudden change in demand like that caused by the introduction of services like Netflix. He said with other technologies, the purchase of more capacity and connection of it can often be software controlled, taking just a few days after getting agreement with your supplier. But with cable, the equipment located in suburban cabinets must be upgraded, usually an installation involving buying equipment, having it delivered and installing it so that the operator can redistribute the user base on any single cable onto new backhaul. Each cabinet provides cable for a small base of subscribers, so Vodafone has a lot of cabinets to visit and install equipment, which is a major project. The good news for Vodafone HFC customers, reinforcements are on hand, or at least only about a month away. Vodafone Technology Director Tony Baird told NBR, since its development, the HFC cable network has had yearly capacity and technology upgrades, with a major step change in technology approximately every 3 to 4 years. Due to the sudden surge in demand, Netflix traffic on Vodafone's network growing by 83% during the school holidays, we have needed to further accelerate network upgrades, which have been fast-tracked. He said we've invested millions this year into the HFC network to improve capacity and expect most of this work to be complete by August, with full completion in September.
NBR. With a National Business Review smartphone subscription, you can read or listen to the latest from NBR online. And for a limited time, it's free. Join NBR's Intelligent Business Network today and get free smartphone access to NBR online until August 31st. NBR doesn't do sport, weather or horoscopes, just timely, relevant, useful and insightful business news. So for business news you can use for free, visit nbr.co.nz/free.